Hi everyone, and welcome to the second tutorial in our series of US stock trading for beginners. So today we're going to look at a couple of topics which I'll run through in a second. But first, just so you can follow these tutorials, I'm using the TradingView platform in my examples and for my technical analysis. So I'd recommend that you use the same. It's up to you, but I find this really useful. I have an account with TradingView, a paid subscription, and it ranges. There's a free version, and this can go all the way through to the top sort of level, which is $49.95 US per month. It's not a trading platform, as I mentioned in the previous tutorial, but I find it really is an essential tool in helping me to plan and analyze my strategies for trading. We'll talk more about how we actually initiate trades and how we execute trades through TradingView and linking that with brokerage platforms. But today, let's just look at some of the basics. And the first thing we're going to start with is understanding candlestick charts, what they are, what they represent, and what information we can extract from candlestick charts. The second one is we're going to be looking at trends. What do we mean by trends, and how do we determine the trend of a particular stock? We're also going to be looking at the definitions or the terminology of long and short trades. I'm sure that you've heard of this before. People talking about going long or going short, bullish and bearish, and what that means and how that ties in with our trading strategies. Also, we're going to be looking at the first of many technical indicators, moving averages in this example, because that's going to help us to determine the trend. But I'm also going to talk about the volume indicator, which is a pretty standard technical indicator that is used to analyze stock information and tell us what is happening in the market. So that's what we're going to be covering today. And without any further ado, let's jump straight into that. So the first thing is candlestick charts. What do they mean? What is a candlestick and what does it represent? Now on the screen here, and I'm using TradingView as my technical analysis platform and my charting tool, we can see that there are these green and red objects in the chart. And at the bottom, this bar chart here, we can see that there's something happening there as well. So these green and red elements are candlesticks, and they basically tell us what the day's opening price of a stock was, the closing price, the high and the low, and which direction this price was being driven, whether that was upwards, in other words, bullish, or downwards, which we refer to as bearish. Right here, we see a red candlestick, and notice that I've set my time frame to daily. I focus on short-term trading or day trading. In other words, when I plan my strategies and when I execute my trades, I'm trying to look at the next 5 to 10 days ahead. So if I buy stocks today, I'd like to be selling them within the next week, maximum 2 weeks, and take profits and move on to the next trade. And we'll be talking about the methodology behind this strategy that I'm going to be covering in these tutorials. But for now, all you need to understand is how to read these candlestick chart elements, the technical indicators, and the volume chart. So let's start with the candlestick charts then. The red candlesticks indicate that we had a bearish movement for the day, since we're on the daily time frame. It means in the full body candle means that we opened at the top, in this case 100, and let's see here at the top left we can see what it's showing us. We opened, the O is 157.93. We had a high of 158.18, so that'll be the wick of the candle, the top part of that wick. We had a low of 156.87, which is the bottom part of the wick, and we finally closed at $157.11. And it is red because we started at a higher value than what the ending value, the closing value, was for the day. So that means the price was driven down. Now, when we see a green candlestick, exactly the inverse of that occurred. In other words, we opened here at the bottom, in this case 156.81, and we had a high of 158.44, a low of 156.33, and we had a closing of 158.20. So that means we had a bullish candle for this particular day, and it's indicated in green. Here, between these two, you can actually see that we've got a candle with a smaller body and longer wicks, which means that the open and closing price were very close to each other, but the highs and the lows of the day varied and ranged quite a bit. So that tells us something about the psychology of the market. It tells us that there were buyers who were pushing up the price, or sellers actually, who were pushing up the price, and we had buyers who wanted to drive the price down again. And ultimately, on the last day here, the buyers were winning and overpowering, and the price was driven down quite a bit. On this indicator here, on this candlestick here, we can see that there was a little bit of indecisiveness, and the open and close was quite similar, although we can see that the price, there was an attempt to drive the price up much further, but that didn't succeed, and the price much lower, and that didn't quite succeed. So we closed in a range, in a price that was close in range with the opening price. Now, that is pretty much how you read these candlestick chart items. At the bottom, we see the volume indicator, and these are either green or red. And this also tells us, what was the interest in that particular day. When we see higher volumes, it means that there was a lot of activity, a lot of buying and selling, a lot of trades that were happening on that particular day. And this could be driven by events in the news. It could be because there was an earnings on this particular day that was made public. So this usually drives a lot of attention to that particular stock. And that's exactly the case here. You'll see that there's an E here. And if I click on that, it shows me that the earnings and revenue were made public on this particular day, and they were favorable. So that is what drives a lot of traffic to this, or interest to this particular stock on this particular day. And we're looking at Walmart, by the way. So in Trading View, I've got Walmart selected here, and we'll, again, in future tutorials, talk about the platform I'm using, Trading View, and where to find things and how to set yourself up. But for now, let's just focus on some of the basics before we get into the more technical stuff. Okay, so that pretty much covers the candlesticks and the volume indicators. Just note that in some cases, these candlesticks might appear in different colors depending on the platform that you are using. In my case, green represents bullish and red represents bearish, but they could also be full black-bodied candles in some application for bearish, and then empty white-filled candles with a black border or boundary for bullish candles. And I'll show you an example of that here on one of the very resourceful websites called investopedia.com. And here, when you look at the explanation of candlestick components, this is how they are indicated. So you can see the black body here. The open is higher than the close, indicating to us that this is bearish. And on the bullish, we can see the close is higher than the open, indicating again that this is bullish. There are there is additional content here on candlestick bar charts and bar charts, candlestick patterns, and so forth, but we're going to cover all of that in future tutorials. Finally, we're looking at the technical indicators here on the screen, and you'll see these lines here, and they are called moving averages. And what this helps us to identify is shorter term and longer term trends of the current stock. And what is a trend? A trend is telling us whether the stock is heading upwards or downwards over a period of time. And we can see here, if we zoom out a little bit and we look at a wider date range, that this stock has been trending upwards. So if we just draw in a line here from this low to this low here, we can see that we've got an uptrend. This is also evident in the moving averages that has been placed on the chart. Now, in Trading View, to add technical indicators to your workspace is quite easy. If you click here on indicators, you can start typing things like volume, and you'll find that if we don't go to the community scripts, because those are custom scripts, if we go to the built-in indicators, we'll find the volume indicator there. Of course, I've already got it in my charting area, so I don't need to add it again. And if we look at moving averages, You'll see when I start typing that, and let's just make sure that I type correctly. We've got several components here for moving averages. Now, I've used the one that says moving average ribbon, which allows me to place several moving averages of different time frames on the same indicator. And if I just access the properties there, you'll see that I've got a range here for 20, 50, 100, and 200. I might want to change this to 150 at a later stage, but for now, that's fine. Now, what does this mean? The first three are depicted as EMA, and that is just short for exponential moving average. It means that we're looking at a shorter time frame, and we are trying to find a trend over that short period, looking back 20 days. On the next one, we've got the exponential moving average for 50 days, and then we've got an EMA for 100 days. Finally, we've got a simple moving average over 200 for 200 days, which is the one we see here at the bottom. And we've colored or used the style here to indicate this for us. Now, the fact that all of these are stacked quite nicely, we've got the 20, then the 50, then the 100, then the 200, tells us that it's consistently following this trend. If we look at some stocks where those lines overlap, such in this case, it means that we have a trend change. So if we zoom out a little bit in this particular example, we can see that we've moved from a bullish trend here to a bearish trend, and suddenly here where we've got these lines crossing over, we can see that there is a change in the trend again. So it's changed from moving downwards, kind of consolidating here, just moving in a linear line, in a horizontal line, and then moving up again. So we've got this trend change occurring there. But when we look at the Walmart stock, again, we can see that for quite some time, it's actually followed this upwards trend. And you'll see the same thing happening in many different stock types. Amazon might be a good example of a crossover. And if we look at something like Apple, which is probably not on my list here, but I can find it here, we should be able to see, consistent upward trend for at least the last couple of months. So that is what we use as an indicator, a technical indicator to help us determine trends. Now, I've got some interesting information here for you, and I just thought I would share that with you. And these are from my own personal notes that I followed. And this particular one, I leave references to in the description, but this is pretty much an approximation or a theory on how stock prices are correlated. And according to this author, it says that 70% of a stock's short-term direction is influenced by the market and sector industry trend, right? So if we want to go long, which I'll explain in a bit, on stocks when the market are respective of this respective sector trending is up, that gives us the highest probability of success. Also the inverse, if we want to go short, which I'm going to explain, then that means we need to look at the respective sector trend as well as that S&P 500. And I'm going to explain what going long and going short means. So let's look at Walmart again, because it's a good example in this particular case. Now, let's say I wanted to trade the stock. If the trend is bullish, what would make the most sense? Would it make sense to say, no, the stock is going to go downwards? Forget this predictive line that I've got in there. This is just a silly indicator that in this particular example doesn't make any sense. So I'll switch it off. Now let's look at the stock again. If we want to invest in a stock, of course, we would like to buy at a cheaper price. And then we would want to wait a little bit until the price goes up and sell it. And of course, the profit is the difference between the sell price and the purchase price. And hopefully, if it's favorable, then we make a profit. So buying low, selling high. This is called going long. So when we say we're going long, it means we buy low, we sell high, and we make a profit. If we go short, on the other hand, it means that we are borrowing a stock at a higher price. So I am borrowing a stock, let's say Walmart here, at a price of where it is currently $157.11. So I'm borrowing this stock, right? I'm borrowing 10 stocks. So it's going to cost me $1,570, right? I'm buying 10 of these stocks. Then a week later, the price has dropped down by 10%. right? And what I do then is I buy the stocks back. So I borrowed the stocks at $157, but a week later, I am buying it at let's say, for example, $145. And I am then giving that stock back to whoever I borrowed it from. But I paid less for the stocks than what they were worth when I borrowed them, which means I still make the difference. It's a little bit difficult to comprehend the first time. Going long is easy because we buy low, we sell high. Going short is a bit more complicated because what we are doing is we are selling high and then we are buying back low again. But we're not really selling at that moment. We are borrowing the stock at a higher price. And when the price drops, we buy it back and we give it back. So that is the same as saying that I am borrowing, let's say, a 100 boxes of t-shirt from my friend. I've got a business where I sell t-shirts and I've run out of supplies. And now I'm borrowing 100 boxes from my friend who's got a similar business. And these are valued at $10 per box of t-shirts. I borrow 100 of these boxes and I go to market and I do my business and I sell these to my consumers. But a week later, the price has dropped from $10 to $5 for these boxes. So all I have to do is to buy 10 boxes back. I'm giving my friend 10 boxes back, but they cost me less now than what they cost initially. To my friend, it makes no difference because he gave me 10 and I'm giving him 10 back. But to me, it makes a difference because I borrowed them at $10 a box and I bought them back at $5 a box. So I make that difference between the two. And this is the principle of going short. And we can visually demonstrate that here. And I'm going to show you the difference between the two. So first we'll do going long. Now, if the price here closed at $157.11, it means that I will enter the market slightly above the closing price. So let's say round about there. We'll enter at $157.26, for example. We will set our target profit price and we'll talk about position sizing and how we determine that target profit line at a later stage, as well as our stop loss. And I'm going to explain what that means. In stocks, when we buy and sell stocks, there is always risk involved, right? So we have the potential of losing money as well as making money. So there is a risk factor and there's a reward factor. And what we would like to do is to measure the risk versus the reward. Now, in this particular case, when I created this trade object here, I haven't traded really, I'm just planning. But when I create this, I set my target price. So where do I hope to sell the stock at? Where did I buy it at? And the difference there, the green box is my profit. And then where do I draw the line when I'm losing? So when the stock starts dropping down, where am I going to draw the line to say I'm going to cut my losses and move on to the next stock? Because if we keep hoping that the stock is going to go up when it's actually moving in a downwards trend, we stand to lose more and more. Plus, our money is tied up in that stock, so we can't repurpose that to another stock that can actually start yielding some positive returns. So this is all bad. When a stock doesn't go in the direction that we were hoping it would, it means that we're losing money. Number one. Number two, the money is tied up and we can't actually repurpose that. So our money is not working for us. So what we do is we set a stop loss. We say, no, if it drops below a certain value, then we cut our losses and we move on. Now, that loss we need to calculate. And again, we're going to do that in the next tutorial, and it's called position sizing. And I'll explain all of that in due course. For now, just understand the concepts. So we'll set our stop loss somewhere. We'll tell our strategy where to set the stop loss, and that is 1R, or the risk, and we'll just call that 1R for now. And then we determine our target price based on the risk, or the R. And when you start trading, a good number or benchmark to set that up is about 1.5, a ratio of 1.5, meaning that my target profit or my profit margin is 1.5 times the risk. All right, and that is where we will set our pricing ranges. We're going to buy at this level, we're going to sell at that level, and we're going to place a stop loss at this level here. And this would be a long trade. Now, if we decided based on technical indicators and information at the best guess that we wanted to go short, we have to do the opposite. That means we would sell or borrow this at just below the closing price again. right? So we're going to place our price over there. We are going to set our stop loss, which is now here at the top. And for the purposes of this exercise, not guidelines to trade by, I'm going to set it just above the close of the high of the previous day. And then we again will set our take profit to a ratio of about 1.5. By the way, these ratios can vary anywhere between 1.5 all the way up to 3, within reason, of course, depending on your experience with the stock market, the confidence in your strategy, and based on the indicators that you are reading. And then, of course, we can also set the range over what period would we like to achieve that. And again, we're going to explain all of this in the next tutorial. But this strategy here, or this trade that we see here, is called a short trade. So we are borrowing these stocks or selling them later when the price drops and it gets down to this level. We're going to buy them back and we'll return those stocks, and we will then take the difference as profit. This is really good because what this means is whether stocks are trending upwards or downwards, bullish or bearish, we can still make money. Of course, when stocks are going up, so we buy low, sell high, we're making profit. But when the market turns around, and I've got an example here somewhere for you of a bearish stock, a stock that is in a bearish trend, and here we can see we've got these exponential moving averages that sits above the candlesticks, and they're stacked quite nicely, one above the other, and they're not crossing over, which means we are consistently in a downward trend here, or a bearish trend. This would be a good stock to go short on because we know the probability of the stock trending downwards is much higher than a reversal, which is possible, but we'll talk about that in the future. Now, remember we said in the screenshot here that 70% of a stock's short-term direction is influenced by the market and sector or industry trend. Now, how do we determine what is the market, sector, or industry trend? Now, if we look at Walmart here, there's some information here in TradingView telling us a lot about the stock, but it's not really telling us what sector this belongs to. So an easy way to do that is to fire up your ChatGPT. You don't have to have a paid description for this, but if you do, it helps. And all I did is I said, which sector does Walmart US stock belong to? And it's telling me here it belongs to the consumer staples sector. Now, once you've got this information, head over to sector SPDRs or sectorspiders.com/all sectors. This is free. You don't have to log in or register or nothing. You can access this in your web browser. And once you've done that, we can see here it belongs to consumer staples. So if we go to consumer staples here, we can click on it. And what it's going to do is it's going to give us information on the trend of this particular sector. And we can see on different ranges from 1 day, 5 day, 1 month, or 3 months, what this sector is doing in the light blue line compared to the S&P 500. And again, if we refer back to this slide I've got here, we are looking at the S&P 500 plus the sector industry, and if both of those are heading in an upwards trend, we have a 70% chance of the stock following that trend. And the exact inverse would apply again to stocks in a bearish trend. Okay, so that's how you can easily determine that. The date range that I'm looking at is 1 month in my particular case. As I mentioned, I like to do day trading short term. So I'm not buying stocks for the long run. I want to buy now and then sell within 10 days maximum. Less is better because that means I free up money when I buy and I sell. My money is released and I can start investing that in the next stock and take profits. In this particular strategy that I'm going to be talking about and that I'm following, we're not looking at making the maximum amount of profit margin. We are looking at making consistent successes and positive margins on our trades. So sometimes when you buy a stock and you sell a stock, you afterwards realize, but actually I made 5 or 10%, but that stock almost doubled in price. I could have made 100%. And you feel like next time you should actually wait a bit longer. The truth is in this that we are playing a best guess game here. Think about a casino. The odds of Russian roulette is whatever, let's say, 50-50 to the house and the gambler. But The house has a slight advantage because they would implement certain strategies such as the surrounding, the atmosphere, the psychological impact, whatever, that gives them a slight upper hand. And what we are doing here is exactly the same thing. We are saying that if we trade 10 stocks, for example, if we perform 10 trades over the duration of a month, we are trying to win more than 50% of them, because that means that we're making a profit. The losses that we incur is the cost of business. And as long as the profits outweigh the losses, then we are in good business. We're making money. And this is also the logic behind setting our target price ratio to our risk to reward ratio as 1.5. It means that if we win 5 and we lose 5, which the law of averages said we should be doing, if we are gambling, purely gambling without any technical analysis or planning, then we still win, because if we have 10 trades, we win 5 and we lose 5. Remember, we set our risk at 1R and our profit at 1.5R, which means that if we reach those target prices and they're realistic and they're based on some realistic values that we will calculate, then it means we're still in the positive. But we don't want to win 50% of the time. We want to win 60 or 70% of the time if we can. And we take small chunks and we do that consistently. And that is referred to in the training description, the link in the description that I was referring to earlier as piranha trading. And it means taking small bites consistently out of these trades so we can build our portfolio. And that was all that we were going to cover today. So I hope that makes sense. If you have any questions, just post them here in the comments, and have a look out for the upcoming videos. Subscribe here at the bottom and then you'll be notified automatically. And we hope you enjoy this and hope to see you in the next tutorial. Until later, thanks and bye.